Hello from our webinar for Unravelling FAS 35. I'm Minahal Shahzad, working in Audit and Assurance at Deloitte, Bahrain. As you're all aware, the new standard FAS 35 was developed due to the need for revision of FAS 11. With me today to discuss in depth some key issues with the old standard and to provide an overview of the new standard is Irshad Mahmood. Irshad is the partner at Deloitte & Touche Bahrain with over 25 years of professional experience, specializing in financial services, including Islamic banking. He is also a board member of the AAOIFI and a member of the Technical Accounting and Interpretation Committee at the AAOIFI. Now, with reference to slide 4, Irshad, could you please provide us with a brief history of the development of the new standard? To be very precise, why was the standard developed?
Thanks, Manahid. Let me summarize the key reasons for the development of the new standard. Firstly, FAS 11 was outdated and due for review. Secondly, the scope of FAS 11 was restricted to only recognition, classification and presentation. It fails to provide any guidance on the accounting treatment, including measurement. Additionally, there were several other issues. For instance, risk weightage and reserve calculations were not taken care of by FAS 11. Also, the accounting for the reserve was linked with the quasi-equity instruments rather than the underlying assets. And finally, there has been a shift from the incurred loss model to the expected loss model under the FAS 30. In view of the above, two new standards were issued by the AAOIFI, mainly to align FAS 11 with the improved global accounting, financial reporting, as well as regulatory requirements.
Thanks, Irshad, for providing the key reasons for the development of the new standard. Now, referring to slide 5, could you please let us know what do the two new standards deal with?
Well, as you're aware, FAS 11 dealt with provisions and reserves. The two new accounting standards required the application of futuristic approaches. For example, FAS 30 contained guidance for impairment, credit losses and onerous commitments, whereas FAS 35 contained guidance for setting up risk reserves, including the approach, calculation, accounting, timing, utilization of risk reserves and linkages with the FAS 30.
We'll keep the requirement of application of futuristic approaches in mind. Now, is the adoption of the new standard mandatory for all Islamic institutions?
For the adoption, most importantly, the standard is not mandatory. And if an entity establishes risk reserves, it should apply FAS 35 in its entirety. Also, the standard is not applicable for takaful, i.e. Islamic insurance entities, risk reserves created to mitigate the operational risk, as well as the regulatory and statutory or any other similar risk.
Since you've mentioned that FAS 35 provides guidance for setting up risk reserves, can you provide us with the definition of risk reserves?
Looking at the slide 6, you can see that it sets out the definition of the risk reserves, which is a sum of investment risk reserve and the profit equalization reserve. We define the risk reserve as a component of the equity or quasi-equity set aside by way of appropriations from the respective earnings for the benefit of the respective stakeholders. Moreover, both reserves are the amounts appropriated out of the income arising from the relevant assets. Hence, it is important to note that for the IRR, investment risk reserve, it is to mitigate the liquidity, credit, market and equity investment risk, whereas for the profit equalization reserve, it is to mitigate the rate of return and the displaced commercial risk.
Now, before the creation of the risk reserves, what are the conditions that have to be met?
There are two main conditions that must be fulfilled before creating the risk reserves, whether it's IRR or PER. The firstly, Sharia approval, and secondly, and the most importantly, a contractual arrangement with the depositor or the investment account holder is required as a precondition before we set the reserve.
Now that we have discussed the conditions that have to be met when it comes down to the adequacy of the risk reserves, as shown on slide 7, what exactly is considered as an adequate level?
For the investment risk reserve, it is considered as adequate when it is sufficient to absorb the combined monetary effect of liquidity, credit, and market risk, including the equity investment risk. On the other hand, for the profit equalization reserve, it is considered adequate when it is sufficient to absorb the combined monetary effect of rate of return risk or the risk-based commercial risk. The combined monetary effect should be calculated as per the accounting policies developed in accordance with the best practices of the risk management. Importantly, in safeguarding the long-term interest as well as smoothing the profit to the investment account holder and other participating stakeholders is a primary consideration for maintaining such reserves.
In addition to the considerations that you have mentioned for the adequacy of the risk reserves, what does the Islamic financial institution assess at the end of each reporting period?
Well, an Islamic financial institution should assess at the end of each reporting period whether the risk reserves established in line with the accounting policies as well as principles defined by FAS 30 are adequate.
Now that we have covered the adequacy of the risk reserves, could you please share with us the accounting implications relating to risk reserves?
Okay, referring to slide 8, first of all, an Islamic financial institution should develop the accounting policies for maintaining risk reserves that should be in line with the principles defined in the new standard, which should include risk management, risk reporting, and objective risk evaluation methodologies. Moreover, the Islamic financial institution would have to establish suitable accounting policies for development and maintenance of risk reserves to provide just and equitable treatment for the respective class of stakeholders over a longer period of time. Additionally, an Islamic financial institution should assess at the end of each reporting period whether the risk reserves established in line with the developed accounting policies are adequate.
Establishment of suitable accounting policies for the risk reserves and assessing whether the risk reserves established in line with them are adequate when it comes down to their accounting. Point noted. Now, moving to slide 9. As per the principal guidance, what are the requirements for the development of the accounting policies?
Okay, as far as the development of the accounting policies are concerned, there should be just and equitable treatment for the respective class and classes of stakeholders over a longer period of time. Maintenance of risk reserve at an adequate level, as well as in the case of shortfall in the risk reserves, a defined plan to bring the risk reserve at adequate level.
Now, looking at slide 10, it outlines the accounting for contribution, attribution, and utilization. Let's start with the accounting for the contribution for the risk reserves.
For the contribution to the risk reserves, they would be accounted for as charge against the income of a respective pool attributable to such stakeholders, commonly referred to as the participatory pool or investment pool. One thing which is very important to be noted, it will be an income statement charge and fall in line with the contractual and Sharia requirements.
Moving forward now, let's discuss the accounting for the attribution for the risk reserves.
For the attribution, the profit equalization reserve should always be created from and attributed to income attributable to both the relevant stakeholders and the shareholders. Shareholders acting in the capacity of mudarib or working partner, as well as in the capacity of investors, in case of commingling of funds. The IRR, or the investment risk reserve, should be in line with the relevant contractual and Sharia requirements and either be created from and attributed to the income attributable to the relevant stakeholders and the shareholders when acting in the capacity of mudarib or working partner, as well as in the capacity of investor in case of commingling of funds, or in the capacity of investor in case of commingling of funds, but not in the capacity of mudarib or working partner, which is basically vice versa.
Now, lastly, what about the utilization of the respective risk reserve?
Now, in the case of situation mandating utilization of the respective reserve or the risk reserves, the same should be reversed to increase the income of the respective pool and should not be directly netted off with the respective loss.
You have mentioned a case where it would require mandating utilization. What do you mean by mandating utilization?
When we say mandating utilization, we meant to say that utilization should be where there is an event of loss or an event of where the risk reserve is in accordance with the Sharia requirement and you cannot just simply reverse it.
Now, could you please share what type of events may require the reversal of risk reserves?
Okay, referring to slide 11, to start off, a risk reserve previously maintained may no longer be needed or may require a reversal. This situation may arise when the respective event of reversal occur, which could include one of the followings. Firstly, the amount of reserve maintained being more than the amount actually needed. That will result in partial reversal. Secondly, when the respective investment instrument is liquidated in full, i.e., whereby the event of reversal is the actual liquidation and full settlement of the respective investment instrument, that will be considered as a full reversal. And finally, if the Islamic financial institution changes its risk management policies with respect to one or more of the risk or one or more categories of stakeholders being no longer required, or there are regulatory imposition disallowing maintaining of such reserves.
Thanks for sharing the various events. Now, in addition to that, what is the accounting treatment for the reversals? Well, based on my understanding, correct me if I'm wrong, reversals, whether in partial or full, should be recognized when the event of reversal occurs and reversed to the respective income from where these were created, unless either a contractual requirement or a Sharia requirement mandates otherwise.
Yes, in addition to those points you just mentioned, if the class of stakeholders which is beneficiary of the utilization of risk reserves is different from the class of stakeholders from whose income such reserve was originally created, appropriate disclosure of transfers and adjustments along with the justification of the same should be made in the financial statements. Secondly, any adjustments and transfers between reserves should be accounted for when these occur in line with the contractual or Sharia requirements as applicable. This includes the adjustment and transfers required under transitional provision of FAS 30, which is impairment, trade losses and onerous commitments.
Now, moving forward to slide 12. What are the requirements for presentation as per the new standard?
For the presentation, a clear requirement is the share of risk reserves attributable to each class of stakeholders should be shown as an addition to the equity of respective class of stakeholders. Any portion of the same attributable to the shareholders should be shown in the owner's equity. Additionally, the risk reserves attributable to the investments kept off balance sheet should be disclosed in the statement of off-balance sheet investments.
Now, for each type of risk reserves, what are the requirements for disclosures? Based on my understanding, for each type of risk reserves with respect to each category of stakeholders to whom they would relate, they would have to disclose the accounting policies.
Yes, your understanding is correct, but let me add something over here. In addition to the accounting policies, you also need to disclose a movement providing the summary of opening and closing balances along with the amounts attributable to such reserves by the respective class of stakeholders, of course, as well as the shareholders where applicable. Secondly, the utilization of such reserves and reversals, if any, to maintain the adequate level as well as any other adjustments, including transfers duly describing the nature of the same. And finally, the shortfall against the adequate level and the defined plan through which the same should be recognized. This is the major requirement that's introduced under FAS 35.
Now, moving to slide 13, could you show us a sample computation of the PER and IRR with an application to a scenario?
Yes, as you can see, the slide 13 shows a sample computation of the profit equalization reserve and the investment risk reserve with an application to a scenario. You will note that both computations show the total possible impact and the adequate level of profit equalization reserve and the investment risk reserve to arrive at.
Thank you for providing us an insight on FAS 35. Now I just have a few additional questions. First of all, when will the standard take effect? As of which period?
The standard will be effective from the financial periods beginning on or after 1st January 2020. This standard will become effective along with FAS 30, impairment, credit losses and onerous commitments, and its adoption would be subject to the transitional provisions provided in the SAD standard.
Alright, thank you. And can the standard be implemented earlier than the date of effect?
Yes, early adoption is permitted. Only if the Islamic financial institution decided to early adopt FAS 30, which is on the impairment, credit losses and onerous commitments. In that case, early adoption is permitted.
Now, we have certainly covered a huge ground in this discussion. Thanks for your time, Irshad. And I'm sure everyone listening will have taken away insights, whether they were technical issues or considerations of the processes. Thank you and goodbye.